Welcome to Stock Shots. Today is Friday, January the 9th, 2009. We're so pleased to have as our guest today, Matt Mccall of Penn Financial Group. Matt is a frequent guest on Fox News' Bulls and Bears and also on Happy Hour. Matt has also recently authored a great new book, The Swing Trader's Bible, Strategies to Profit from Market Volatility.
Matt, thanks for being with us on Stock Shots this morning.
Thank you very much, James.
Matt, we've heard a ton of different forecasts for 2009. Most of them have been bad. I've heard you make some positive comments. Would you give us your forecast for equities in 2009?
Absolutely. You know, I'm looking for gains approximately between 20 and 25% on the upside. And it sounds pretty high considering what we just went through in 2008. But if you look at things in a grander scheme of things, you have the S&P that closed right around 900 in 2008, a little bit above that. So a 25% gain, you're only looking at the S&P moving up towards 1100, really the same level we were in September of 2008. So I really don't think I'm overshooting, looking for a pretty positive year in 2009. Also, if you look back on history, since the mid-40s, we've only had two instances where we had consecutive down years. So I think the odds are somewhat in our favor for a bit of a bounce. That being said, James, I do believe we're going to have some pretty negative economic news to the first quarter, maybe second quarter of 2009. However, most times in recessions, the market has already discounted the future where it bottoms about 6 months before the news starts to change. So I think the news starts to change probably early second quarter, but the market's already going to be about 30 to 35% off the lows by that time.
Well, that's great to hear, a positive forecast, and we have written a lot on our blog about the market being a leading indicator, and I certainly hope that we will see some positive news. What do you think is baked into the jobs number today? How bad is the market prepared for that jobs number today to be?
You know, I don't know if it is prepared for it to be that bad, considering since the Christmas holiday all the way through earlier this week before we had the sell-off on Wednesday, we were up about 8% on the S&P in a matter of 2 weeks, so we actually had a pretty big bounce. Then when the ADP number came out on Wednesday, the market obviously took a hit, but then bounced right back Thursday with a small gain. I don't think a bad number is really baked in, and that concerns me a little bit right now. So if we have worse than expected news here for the jobs number, you know, I think we could see a pretty deep sell-off in the market, probably for the first week or two of January. You know, that being said, it's going to be probably a short-term move, but I don't think we're prepared for a very bad number. That concerns me a bit here before the number is released.
If we saw a big sell-off over the next couple of weeks, where would you be looking to put money to work?
One area that I really like, and it's pretty contrary to most people's thinking, is the energy sector. Reason for this is I'm very, very bullish long-term of the price of oil, the commodity price of oil. We had a big rally going into the end of December, had quite a bit of a sell-off here this week for the price of oil. But I really believe that we're going to trade somewhere between $50 and $70. I know it's a very wide range, probably at the upper end of the range in 2009. If that is the case, a lot of these energy stocks that have been really beaten down will do very well. And the reason I really like the energy stocks is over the last 2 months, as oil continued to move lower, the energy stocks have built a base and moved sideways. So they're starting to show a little bit of relative strength. And if they're able to form lows and hold with oil trading in the 30s a few weeks ago, when oil gets up to 50, 60, possibly 70, I think these companies will be very, very strong, and we're going to see a lot of them start breaking out. I like some of the larger names, as a matter of fact. I was playing the smaller names during the last oil run that we had, but I like some of the larger names right now, just based on the reward to risk that's out there.
Well, I tell you, I can't tell you how glad I am to hear you say that. I've been bullish on energy, particularly natural gas. I live down near the Haynesville Shale find and the Barnett Shale natural gas finds, and we were seeing a ton of leasing, and then it just started to really dry up, but that was back back in the summer. We were looking at nat gas prices at $14 a million cubic foot, and now we're down closer to $5. But I can't see nat gas particularly staying at these levels as the economy rebounds at all.
No, as a matter of fact, I was doing some research for my 2009 outlook for my clients, and one of the things I was really caught my eye was a longer-term chart actually of natural gas, how we're coming down to a multi-year low here in the $5 range, 5 and change. And if we hold in this level, I think it's a really nice buy. And you always get that spike. It seems every year or two you get that big spike in natural gas. And, buying down here at this level, the actual commodity natural gas, I think is not a bad reward to risk play at all. I have a fairly tight stop, and your upside is a few dollars, I think, on natural gas, where it could easily run to $7 or $8 in the right circumstances. And you think about that as far as natural gas stocks, they're also going to join right in with that gain. Yeah, I like natural gas a lot. I like the entire energy sector as far as equities and the actual underlying commodity as well.
We've been kind of exploring on our show the inflation versus deflation argument. We've had a lot of people recommend gold, and even for a variety of reasons, even those that aren't really looking for massive inflation, maybe hyperinflation. They like gold just as an alternative to the U.S. dollar. Do you have an outlook on gold?
I do. Actually, we've owned gold. We bought into gold just about $600 an ounce about a year or so ago. We've held on through the ups and downs. I still own gold right now. We use the GLD, the gold ETF, as a way that we diversify our portfolio. And I like it for a number of reasons. One, diversification, like you just touched on. I think it's great to diversify your portfolio. Two, I think inflation is going to be an issue. And to prove that, I actually own the iShares TIPS ETF too, TIP. So I do believe inflation is going to be an issue with the government, just printing press of money that they have. I think inflation eventually will creep in. I don't believe in hyperinflation as of yet, but I think inflation will be an issue in 2009. Also, another reason I like gold is the fact that the U.S. dollar did break a long-term downtrend in 2008, a multi-year downtrend in 2008. Had a major run, though, from July of 2008 through November of 2009. And we've since pulled back a bit. And I think the dollar's going to weaken a little bit here. And the U.S. dollar index is around 81 right now. I think we can come down to 74 and retest the support level. If that happens, gold and other commodities really take off. I also, as a matter of fact, I don't own right now, but I also like silver and platinum. Those are two that I'm looking at as possible purchases as well, using ETFs to buy them.
What's the best ETF for platinum?
For platinum, I look at a couple different. The one that I look at that's got pretty good volume is the E-Trax UBS long platinum ETN. That symbol's P as in Paul, T as in Thomas, M as in Michael. That's probably the best way to play it. It started trading back in May, and it was around $26. Came all the way down to $10 in December. Got crushed. But recently formed a nice little what they call saucer bottom, broke above the 50-day moving average for the first time in December, and then over the last couple of weeks, we've actually moved from $10 and closed at $13.40 just yesterday, up another 4%. And what I really like about this, too, is ETN didn't trade much at all. It traded maybe 10,000, 15,000 shares a day. Over the last 3 trading days, that volume has jumped up to 300,000, 400,000 shares a day. So you're seeing some big money come into platinum as well.
Do you think there's a lot of money on the sidelines, or do you think the Madoff scandal has really caused investors to just shy away from equities totally, or is that money ready to come back into the market as soon as we hear some positive news?
I think it's sitting there ready to come back in. Yesterday's morning's Wall Street Journal has the money market report, $3.81 trillion sitting in the money markets right now with an average yield of 0.7%. So that's, I got to tell you something. You can't keep $3.8 trillion getting 0.7% forever. You're not going to keep up with inflation. It's just you might as well put it in your backyard under your pillow at that point. So I think it's poised and ready to come back in. The Madoff scandals definitely hurt a bit. But keep in mind that, you and I are in the market. We know this type of stuff. But you talk to somebody in middle America, they may have never even heard of the Madoff scandal. It doesn't really mean much to them. So they're going to keep putting money in the market. They may have pulled a bit out recently with what's going on. But also Americans forget pretty quickly. When you see an opportunity and they hear the media start having some good news and the market starts going higher, the same clients that were calling me 4 months ago and said they never want to be in the stock market again are the same clients that have been calling me the last 2 weeks and said, let's get back in 100%. So Americans forget pretty quickly. So I think that once the money starts going in, we're going to see a massive influx, and they're going to be that hoarding effect. Just like every time it happens, Americans just jump and chase, and we'll probably see the same thing with the money coming in the sidelines.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.